Bitcoin hit $126,000 last October. Everyone called it a new era. Then it dropped. Right now, it's sitting around $72,000, down 43% from the top. And you're watching it, trying to decide, is this the bottom? Do I buy now? Do I wait? What if it goes lower? Here's what I want you to see before you make that call. While retail investors are frozen, BlackRock, Harvard, JPMorgan, they aren't paralyzed. They're quietly moving into Ethereum. Not Bitcoin, Ethereum. Why? Every crypto cycle follows the same sequence. Bitcoin peaks first. Then Ethereum catches up and often outperforms on the way back. Every single time. The question isn't just whether Bitcoin recovers. The question is what outperforms when it does. 5 case studies. 5 institutions. 5 signals. This channel shares ideas, not investment advice. Before we get into the cases, one thing to know. Bitcoin stores value. That's it. That's the whole product. Ethereum is different. It's a platform. Everything from loans to payment rails to ownership records runs on top of it, automatically, without a middleman. Gold just sits there. The internet changed everything that ran on it. That distinction matters for everything that follows. In March 2024, BlackRock, the largest asset manager on the planet, launched a tokenized money market fund on a public blockchain. They chose Ethereum, not Solana, not a private chain, Ethereum. By 2025, that fund crossed $1 billion in assets. Franklin Templeton followed. Hamilton Lane followed. Here's the number that matters. BlackRock manages over $10 trillion. When a firm that size commits infrastructure to a platform, they're not experimenting. They're positioning. Bitcoin can't host a tokenized treasury fund. Ethereum already does. Lesson 1. Institutional infrastructure choices create durable demand, not hype. Structure. This one is worth slowing down on. Harvard University, $57 billion endowment, one of the most scrutinized pools of capital on the planet. In 2024, they disclosed an $87 million position in Ethereum. And here's what makes it significant. They got there partly by selling Bitcoin to buy it. That's a deliberate rotation. Documented, reviewed, defended to trustees. The most careful money in the world looked at both assets and picked Ethereum. That's not a rumor. That's a filing. But this is where the thesis gets stronger. Lesson 2, watch what institutions do, not what they say. The money moved first. In 2022, Ethereum made a fundamental change to how it works. Simple version. Before, it used energy-intensive mining. After the upgrade, holders can stake their Ether and earn a return from real network activity. Right now, that pays roughly 3 to 4% annually. From actual usage fees. Not inflation, not promises. Bitcoin earns nothing natively. Ethereum earns yield. For pension funds and family offices that need to justify every position they hold, that changes the conversation entirely. It moves Ethereum out of the speculative category and into something closer to a productive infrastructure asset. Lesson 3. Yield changes who can own an asset, and at what scale. Here's the part most retail investors miss. Ethereum's on-chain activity just hit all-time highs. The network is more active today than at any point in 2021. And yet the price is down 58% from its peak. That kind of divergence between usage and price is unusual. And historically, it doesn't last. Here's why the usage is there. Tether and USDC, the 2 biggest stablecoins, hold over $150 billion combined. The majority of that supply runs on Ethereum. Put simply, the digital dollar already runs on Ethereum. JPMorgan and Citi have tokenized deposit pilots running on Ethereum infrastructure. The U.S. government is writing stablecoin legislation that will formalize this. None of that guarantees price in the short term. But the foundation is not hypothetical. It's already in use. Lesson 4. The platform that hosts the dollar has structural staying power. In technology, long-term winners are decided by where developers build, not where speculators trade. Electric Capital tracks contributors across every major blockchain. Ethereum consistently holds roughly 20% of all crypto developers. 4 years running. Competing chains are real. Solana had a strong 2024, but Ethereum's institutional relationships and Layer 2 ecosystem continue to compound. Tom Lee, chairman of BitMine, which holds over 300,000 Ether, said it plainly: the list of institutions building on Ethereum is the venerable and elite of Wall Street. Where builders go, applications follow. Where applications go, users follow. Where users go, capital follows. Lesson 5. Developer activity is a leading indicator. 4 years. Same answer. Now, the part I'd be doing you a disservice to skip. Ethereum is volatile, down 58% from its August 2025 high. It can go lower. If you can't stomach watching a position fall significantly before it recovers, this is important information about yourself. Competition is real. Solana now generates more protocol fees than Ethereum's base layer. That trend could continue. The Ethereum to Bitcoin ratio could stay suppressed for longer than any thesis predicts. Bitcoin is showing relative strength right now, and that narrative is powerful. And macro is a real headwind. Middle East tensions, oil at $110, a hawkish Fed, risk assets don't move in a straight line. This isn't a prediction. It's a structural thesis. And structural theses take time, and sometimes don't play out at all. Here's where I'll leave you. The market is in extreme fear. Bitcoin is 43% off its high. Ethereum is 58% off its high. And the biggest, most careful institutions in the world are quietly positioning in Ethereum. Before the headlines. Every cycle, the same thing happens. The people who act during extreme fear are the ones who talk about it later. The people who wait for certainty buy near the top. You've seen the data. What you do with it is entirely up to you. If you're wondering whether to hold through this drawdown, that's exactly what the next video covers. How Ethereum's Layer 2 ecosystem is changing its fee economics and what that means for long-term holders. Subscribe so you don't miss it. This channel shares ideas, not investment advice. All investment decisions are your own responsibility.